Old Mutual reported a 12% rise in first half profit, helped by a strong performance at its South African banking business. Joining us from London for more, Julian Roberts, CEO at Old Mutual. Good day, Julian.
Good afternoon.
Julian, these are complex results, as insurance companies' results are at the best of times, but I must say, reading through the reams of papers, it's difficult to find the essence. But to me, the essence seems to be that the results were as expected and that a lot of the drive came from the emerging markets and then almost ironically also from Nedbank.
Yes, the results were good. They just beat analyst targets, so that's always nice when you beat expectations. We had a growth when you strip out currency impacts of 12% on profits, and we got good sales growth throughout the globe.
Julian, a theme that had started coming through in the last few months, if you look at global companies with a presence in emerging markets, everyone's grateful for the growth driver, the impetus they get from emerging markets, but slowly you're starting to see the currency effects, the volatility there affecting the results back home. What's your experience been?
Well, that's why we always show, and we've done so for the last 2 or 3 years, we've shown our results on a constant currency basis. So people who follow us can actually see how the business is performing without the volatility of foreign exchange markets.
How do you manage that? Do you simply take it as is, or do you hedge out those currency effects? Or is that difficult to do if one needs to focus on the operations?
Yes, we do a reasonable amount of hedging, but not a huge amount. I think people understand Old Mutual is largely South African, the rand, the US dollar, and UK sterlings, and therefore we leave them to hedge most of the currency impacts themselves.
Julian, the tack that the FT has taken on your results is to focus on the West African expansion. You have made this announcement some months ago. Your focus on Nigeria, you're waiting for regulatory approval for the Oceanic acquisition. I'd imagine, though, we know from the banks how difficult it is to find good assets there at the right price. Has this been your experience?
Well, the insurance sector in Africa, and particularly in Nigeria, is very small. So we've taken the opportunity to purchase Oceanic's life business, which EcoBank, when they bought Oceanic, they wanted the bank, they didn't want the life business. So that gives us a base in which we can grow. And our expectation is in Nigeria and in other African countries, insurance penetration will grow as these countries' GDP grows. So it hasn't cost us a huge amount of money to get a footprint in Nigeria.
Could you reiterate what your plans are, your intentions with Nedbank? You've said in the long term you're focusing on insurance and asset management, but for now you're holding on to Nedbank. So how do we read that?
Well, I've made many comments on strategy. The thing that I would focus on is the fact that Nedbank is an important contributor to the group. It's had a fantastic improvement in its profits. Its retail business has been growing the number of customers. It is working, I would argue, better with other parts of the Old Mutual group than it is done in the past, and we're happy with the status quo at the moment.
I'd imagine, because selling it at this point, probably in the next 2 years or so, would be a bit like selling the family silver, given what the results showed today, right?
Well, it's a good contributor, as I said before.
Yes. So looking at some of the South African themes here, for instance, the mass foundation cluster seems to be under pressure. Are these regulatory issues in the sense of changes in the tax regime putting profits under pressure in that market as opposed to the retail affluent sector?
Yeah, if you look at actual sales, our sales were very strong for the first half, 22% up. Slower in the second quarter because, you know, as with other people in that sector, we had to put our agents through their exams. So we put a lot of people out of being on the street into the classroom to get through the exams. They've now done so, and therefore the sales performance, we believe, will pick up back to the normalized level in the second half of this year. When it comes to profitability, the type of product that we have sold isn't immune to a movement in interest rates, and with the 10-year bond yield coming down, that had the negative impact on profits.
Julian, I'd like to look at your capital management and the balance sheet. The sale of your Nordic business helped you to pay out that special dividend totaling £1 billion, and you've also paid off a huge chunk of your debt, and you seem to be on target, as you say, to pay off £1.5 billion of debt by the end of this year. So you are comfortable in doing that. I'm just curious on how you are going to pay off the remainder £400 million.
Well, I showed in our analyst presentation that finished about half an hour ago today that in the last 2.5 years we've gone from having £400 million in the bank to £1.4 billion at head office. So you can see from that our capital position is a great deal stronger. So the last balance of the proceeds of various sales will be used to redeem the remaining £450 million of debt, and then we'll achieve that £1.5 million that we set ourselves. Our balance sheet is strong, much stronger than it was at the end of 2008.
And on target to put the capital aside for the Solvency II regime, with the new regime coming through, regulations coming through affecting insurance too?
Yes, we're very comfortable. We're comfortable with Solvency II in the UK. We're comfortable with the way that SAM is going in South Africa, and Basel III readiness, of course, in Nedbank. So our capital provision is adequate to meet all of the regulatory changes.
Julian, thank you for talking to us from London. That's Julian Roberts, CEO of Old Mutual.